We're here to talk to you today about Step 10, financing your apartment communities. Mark?
Yeah, so in my opinion, if you're going to finance an apartment complex, we always use a mortgage broker. So a mortgage broker is someone that will work on your behalf to find kind of the best financing available out there. They do take a fee. They don't work for free. Nobody expects them to. But a couple of advantages to them. One, they're going to have more clout than you because they do more volume with the lenders. And they're going to be able to work a lot more different relationships that they have that you might not have to get you the best deal.
Okay, good.
Some of the requirements, so let's say you wanted to do a loan, generally speaking, you need 100% or more net worth of the loan amount. So loan's $5 million, you need 100% of that or more net worth, or people can come in and do it with you. And your liquidity after you close needs to be 10% or more, generally speaking.
What does liquidity mean?
How much cash you have, not just cash, it could be stocks, things like that, but it excludes retirement funds, excludes some other real estate. It's not liquid. So it's going to be more along the lines. Typically it doesn't include life insurance policies either. It's more cash, bonds, stocks, things like that. So liquid.
Okay.
So that's 100% and 10% for that. Timing wise, can take 30 to 60 days for a loan. Generally speaking, it's going to depend on type of loan, which we'll talk about here in a minute. And you're going to get 70, 80% generally speaking proceeds for it.
So if the property is 10 million, then you could typically get 7 to 8 million leverage from the bank.
You can sometimes roll in rehab. So for example, Fannie Mae will allow typically up to $5,000 per unit for rehab. Freddie typically doesn't allow any rehab. So it's not uncommon where you can roll in the rehab, and also in some cases you can roll in 3% of the closing cost. So
into both Fannie and Freddie.
Right, depending on, it just depends. It depends on the sponsor, the deal, things like that. So if you talk about Fannie and Freddie, I'm going to say, if you let me take Fannie first. So you can typically get, let's say, 5K rehab, right? And for Freddie, this is typically going to be zero in rehab. Okay.
Okay.
Here you're typically going to get no supplemental loan, no sup. But on Fannie, you can typically get a supplemental loan as well. So supplemental loan is kind of, you think about it as a second loan on the property that goes hand in hand with your first loan. At same date, everything like that. But you'll do it after the fact. We did one where we pulled out about 80% of the money off the value of the property. 75%, sorry. 75% is typically capped at, so 75% cap, generally speaking. And also the rate is typically going to be higher. So on supplemental loan, the rate might be 1% or more higher.
The rate at which you're borrowing the money.
Right, so if let's say the rate today was 5%, just as an example, supplemental might be 6%.
Okay. So why would somebody choose to get a supplemental loan versus a regular loan or some other kind of loan?
Well, the supplemental loan is after you already have the property. So I bought the property, in our example, 2 years later, the value went up, and I got it kind of get like a home equity line of credit in your house, as an example.
Okay.
So you need to pull that cash out. The cash you pull out, generally speaking, too, depending on how you do it, the refi, it could be tax free. Not giving you CPA advice, but the fact is that gets pushed down the road.
Okay. And can you tell our audience who might not know the difference between Fannie and Freddie Mac versus some other lender who lends on apartment buildings?
So with both Fannie and Freddie, you're typically going to get, I'll just put it here, about 30 years amortization. Pretty common. Okay, and it's going to be non-recourse.
Non-recourse meaning if something goes bad with the asset, all they can do is come back and take the asset and not come back after your personal house or car or anything else you personally own.
That's right. Provided there are bad boy carve-outs, you do something you shouldn't do, then that can kick in. But that's for both of them. 30 years amortization, generally speaking. Both cases, you're going to get roughly, it's going to range 5 to 12 years for the loan term. So even though it's being amortized over 30 years, the terminal loan is 5 to 12 It can be longer than that, but that's generally speaking what most people do, 5 to 12 years.
Okay, so the 30 years amortization means that they're going to break down your payments over a period of 30 years.
Right.
And then the 5 to 10 year term means that's really how long you have to make those payments, almost like a balloon.
It's a balloon. That's exactly right.
And then at that time, you either have to refinance or sell the property,
That's
correct?
correct. That's correct. And in both of them, you typically can get interest only, so IO. It will vary, 1 to 5 years. Some people have gotten more than that. We've gotten 5 multiple times.
Yeah.
But you can get some interest only. Advantage of that is you're not having to pay down, you're paying just interest, no principal. So if you're doing a rehab, for example, it might be a good way to kind of get the cash flow going. You're not having to do that. I would take all the interest only I can get as long as I can get it. That's what I prefer.
Okay. Is there anything that's different with Fannie and Freddie versus another bank? If somebody just wanted to not use a mortgage broker, but they wanted to go to some regular bank, maybe right down the street.
Right, so if you're going to do that, let's just say it was a regular, this typically would be about 20 years amortization, generally speaking, not always, and it's typically going to be recourse.
Meaning they're personally liable
Right.
to pay that debt regardless of what happens in the market or tragedy to the property
That's
or
right.
anything.
So those are some key differences for sure. And then you have other loans altogether. You have bridge loan, for example, which gets a lot more complicated. Bridge loan, generally speaking, in both Fannie and Freddie, you want to be 90% or higher occupancy. Okay, so that's for both Fannie and Freddie. Now there are some exceptions for that, but the fact is, if you're 90% or higher, then in the market, then you can get usually Fannie or Freddie. So that's something to consider. Now, if you're below 90%, and let's say you can't get Fannie or Freddie, you might get a bridge loan. So a bridge loan will be kind of a temporary loan from, let's just say, from 1 year to 3 years, generally speaking. The advantage to it is that they work off your pro forma. So you can get, we got a bridge loan, we got 85% leverage, loan amount, and we got 100% of all the rehab dollars.
Can you
That's
tell
huge.
our audience what pro forma is if they don't know?
It was our projections of what the property is, we think it's going to do. Whereas Fannie and Freddie doesn't care. They don't care what you think you can do. They're gonna look at what's actually happening. It's a major difference. So they're gonna underwrite the deal. Their pro forma, what they expect, is gonna be different than the way an investor might underwrite it. So that's very key.
Okay.
So
the mortgage broker that you went to potentially to get a Fannie or Freddie loan, would they also be able to do a bridge loan for you?
most, it depends on them. Not always, but mortgage brokers we use, they do it all, right? They do bridge. Like I said, the advantage for bridge is the leverage is higher, generally speaking. Disadvantage is the rate's usually higher. You're going to have more points, so you're going to pay, let's say, 1 to 4 points in fees.
Okay.
Sometimes that's waived if you actually use them to go to permanent financing. Your costs are going to be higher. For example, your legal costs might be 3-4 times as much
On a bridge loan.
on a bridge loan. Bridge loan might also have what's called a rate cap, which is a way you have to pay, let's say it's $40,000-$50,000, and it's to protect the rate increasing going up and down. So you don't have that on Fannie and Freddie, generally speaking.
Right.
So you're paying these extra fees for a bridge. Doesn't mean they're bad, but just to be aware of that.
Okay.
You also have HUD loans. So not to go too much detail on that, the advantage to a HUD loan is that you can get typically higher leverage. The amortization is 35 years, but instead of 5 to 12 years, it's also fixed for 35 years.
Is that for a new
significant.
property or
It's a new
an
property.
existing? Just new?
No, sorry, the property you're buying.
Okay.
Property you're buying. Yeah, new if your development's 40 years, but
Okay.
for properties we would look at 35 years. So advantage, it does have usually a 10-year prepayment penalty, so that's long.
If you pay it off earlier than that, 30, 40
Right.
years, then there's a penalty.
Right, that's for HUD. Whereas, Fannie and Freddie are going to have things like step down potentially, where it might go down. Let's say it's 5% prepayment penalty your first 2 years, and 4% your next, years 3 and 4. So it's 5, 5, 4, 4, 3, 3, 2, 1. Or there's some things called yield maintenance, which is, generally means your prepayment penalty is going to be really high on a Fannie or Freddie if you have yield maintenance.
Okay.
Other ones with HUD, to downside to HUD is that you can only pay distributions every 6 months. You're going to have usually more replacement reserves, which is money the lender requires you put away for capital type things. Freddie common is 0. It's pretty common to have 0 for replacement reserves. Freddie might be 250 to 300, and HUD is going to be even more than that. And you have kind of a federal agency coming in inspecting you on an annual basis and things like that. So a lot to all these, right? Without a doubt. I'm not gonna go all the details, but if you don't know what you're doing on the financing side, without a doubt, talk to a mortgage broker or lender, whoever you want to. It's important.
And I believe we go into more of the financing differences during our analysis training.
Analysis training, online training, both go into more detail on this as well. I mean, hopefully if you're newer to multifamily, you can appreciate this is much different than single family, and hopefully you kind of can appreciate that you might want to have an expert helping you in this area.
Right, okay. That's all we have for now on step 10, financing. We have many more videos to come. Stay tuned. Bye for now.
Bye.